As we enter the last week of this financial year, I decided to really take a break. And interesting was that yesterday itself, early morning, from what looked like the dollar actually strengthening or the euro selling off at the end of Friday, it completely gapped up this morning, which is what I would have expected to see on Friday itself. And so, with that, EWI essentially confirmed with what I've been saying, that the fifth wave for the dollar index is complete now. Unless something changes, they're unlikely to change that opinion. They were looking at the 99.20 level to really mark that it's complete. So they've done that now, at least for the time being, that the dollar index five wave move for the current cycle that started from the bottom of the dollar, almost 2 3 years ago, is complete, and that completes a larger ABC structure that starts all the way from the 2008 9 8 bottom, right? So that's a 9 year bull market in the dollar. I've been saying that's complete, and so we have some alignment there, and it ended with some very very extremes in sentiment. And some of the reasons I highlighted why it was a good reason to change that view ahead of looking for that missing fifth, which sometimes it's normal. It's not. It's there. It's there in the structure sometimes that you have this wave and you're not sure that there's one more leg. But there were so many divergences, and so I think intermarket analysis between different currency pairs, a lot of the emerging market currencies started strengthening more than a year back. So it was mostly some of the developed market currency pairs that were keeping the dollar up. And so that was not showing the overall change in trend that had happened in the underlying. And the second one was, of course, the commodity prices, which had bottomed more than a year back and did not make new lows with the new low, new high in the dollar or the new low in the euro. The only currency pair which I still think has a strong dollar move left is probably the British pound, because it's formed what is a multi-week triangle and it's almost complete. And the sense is that the triangle really means that the USD GBP will make one more pace to the upper side going ahead, and maybe that will give us some kind of a counter trend push to the dollar sell off itself, because it's a five-way fall in the dollar index that we are seeing so far. And wherever that ends, you'll get some kind of a pullback and maybe a relief rally in equities as well, as they sold off in the last couple of days. But the and that's mostly in the US, because you can mark this fall as a leading diagonal five wave decline. But however, you cannot say that it can't extend, but you are in that part of the structure. So, but the overall trend seems to be down. Weekly momentum indicators rolled over for most global indices, US indices specifically, and our own weekly indicators will probably take time, because we were at the top end of the range. Daily indicators have been diverging, and the key is actually to watch whether the 20 DMA, which is closer to around 9020 breaks. Once that happens, then losing a couple of 100 points should not be difficult. But we seem to be that weakening trend seems to be showing up in stocks more than the index itself, and the only thing that holds it up around this point of time around the year is usually the year end effect. People expect that as we enter the March last few days, there are some banking holidays as well. Some of the settlements get merged, and then stock prices get some kind of support at to hold up for the year end close. But then we have seen times when markets peak in March and sell off into the year end as well. But more often than not, we get some kind of a rebound. So I don't know how the next couple of days will be. So I'm not really trying to figure out how we do for the end of this financial year over the next week. But I think we at least had an initial impulse wave sell off in Nifty and Bank Nifty, which meant after a bounce we see more selling. We saw some of that yesterday, and the point is whether it continues immediately, or we dilly dally around this range for the next couple of days and then sell off only into the wave C or 3 down next week. So that's what we'll be watching out for. And I think it's usually a good time to sit back at March end, essentially because you don't know what the March end effect will be. But the trend seems to be lower so far when you look at stocks and global equities. And the biggest reversal, of course, being the dollar index itself going into a bear market, which is essentially should be positive for commodities, and which is why you saw oil and copper both rebounding from their support levels over the last couple of days again and again, even though they looked like they wanted to sell off sharply. Copper recovered most of its losses yesterday overnight, and that is an interesting trend. So the sell-off in the USD pairs, most of the emerging ones or the commodity ones like AUD, CAD, and even maybe the SGD and so on, don't look complete. They've all made minor 5 wave declines and bounced back. They did not fall with the dollar index this week, but my sense is that many of these pairs will continue to fall in the days ahead, even if they do appear to diverge from the dollar index itself. And the key question then becomes, what is the USD INR going to do? It was very oversold last week. It bounced very little. But in that little bit, the RSI came off from the extreme low readings of almost 20 to back to closer to 30, and now again yesterday we saw the USD INR fall pretty sharply. Not something I was expecting, but if it's happening, then the strength in the INR is akin to what we are seeing in most of the other currency pairs. And that's essentially becoming a trend. We can read into that positive, but it will also affect certain sectors completely the other way. So we should not read into it the way we probably read into it the last time, and see how how the markets and sectors are responding to it, rather than try to correlate directly. But definitely it affects export related sectors more directly than any other in terms of trying to hit margins, but at the same time it provides some cushion from the inflationary effect that is going on. So that's all in this very brief update into this midweek as I record from here in Panchgini. Thanks.